G'day everyone, welcome back to another update for gold and silver. Now gold charts are showing a resistance approaching, so a potential reversal there. Likewise silver is consolidating, it's also showing a potential reversal. We'll include backtesting, so don't forget to hit that like and subscribe button to support the channel. Before we get into the analysis, if you have questions around these daily videos, then reference the +1 videos identified by the +1 symbol, which break down these daily videos into simpler language. As of today, June 16, 2025, gold remains resilient above $23.50 an ounce amid persistent geopolitical tensions in the Middle East and elevated central bank purchases, particularly from emerging markets. US inflation and moderation expectations of potential Fed rate cuts by third quarter continue to support gold's role as a hedge against currency debasement. Silver trades around $30 an ounce, buoyed by strong industrial demand from solar and electronics sectors, especially in Asia. Supply-side constraints from Latin America mines add support to both metals. Investor interest in precious metal ETFs shows slight net inflows, signaling cautious bullish sentiment. So looking at gold first off on the monthly, the price is well above the moving average band, giving us a bullish momentum. There's no CCI for it drawn. Now what I've done here, I've drawn these little ranges in red, because if I zoom in for a moment, you'll see here we've got these little blue areas, and they're fair value gaps. That basically means orders haven't been filled in those areas. And the way you draw these is you look at a candle. So for example, this candle here, you take the candle, the high of the candle before it, and the low of the candle after it, and that blue range is that range between that high and low. You can see here that wick of that candle filled that range, so that those fair value gaps were orders were filled with that wick of that candle. So that's okay. But up here, I've highlighted these two blue areas in red, and that's because they're both fair value gaps. You can see there the high of that one and the low of that candle after it, and then the high of that one there and the low of that candle, it highlights that little blue area. So again, that little range is fair value gaps, orders unfilled, and then further down here we've got another range unfilled orders on the monthly. So that's a pretty long-term play. Remember, this is the monthly chart, and this could take years to play out. I'm not saying it's going to happen next week or next month. I'm just highlighting the fact that those are fair value gaps highlighted on the monthly. On the weekly, what we first look at is immediately what we're looking at is the trend, and what we've got here is the CCI breaking into that moving average range, giving us a somewhat neutral or bullish positioning versus bullish movement on the price above the moving averages. That's the first thing we identify. Next, we identify any divergence, and what we've got at the moment, we've got this long-term bearish divergence, lower highs on the CCI versus higher highs on the price. Now, I've drawn a target range for that, and because that price is still below that high there, if that price breaks higher than that high and the CCI keeps dropping, we're going to just extend that bearish divergence and realign that target. Now that target range is drawn from that high, and we take it back to the significant low before that divergence started, and that's where it's identified by that 23-38% range, which is our minimum retrace level. And again, hasn't reached that level yet, so I'll keep an eye on that in the coming days and weeks. Also note here, we had other, if I zoom in a bit, we had these other fair value gaps I highlighted in blue, and you can see they've all been filled with the subsequent candles after them. Even this one back here was filled with that one there was mostly filled there, and so on. And a couple in there, they were all filled with the candle action there, and these ones as well. Until such time back here, that's the more recent one that orders haven't been filled. So I've identified that, and that also aligns closely with the monthly in terms of a pullback into that range. On the daily, again, the first thing we look at is the CCI and movement compared to the price, and that's bullish momentum at the moment, and both are above the moving averages. Then we also look at any divergence. Now again, if I zoom out, you can see they've got between those peaks there on the CCI, lower highs versus the same period on the price, higher highs, and that's a bearish divergence. It's almost a double top there, but that's still considered a bearish divergence, and that I've marked that in blue. You can see there it broke into that range and then it's bounced out of there, so that's already played out. Although notice the CCI somewhat still declining even though it's broken above the moving average range. Also in terms of fair value gap, which is the last thing we look at, is that range there in red. Those orders haven't been filled Well, in fact, that one has been there. I should probably remove that. So that's been filled with the wick of that candle. But back here, you can see there we've got between that high, and if I just take it out to the current period, that little range is a fair value gap. Hasn't been filled yet. These other ones here have been filled. That was a divergence. Those little fair value gaps have been filled, and all these ones have been filled as well. If I zoom out, so we'll take it one step at a time, but that's really the closest one we've got of orders unfilled on the daily. So next we go to the intraday chart, and we look. So in this case, if you're trading on the hourly or the intraday, we take long positions in the same direction as the daily CCI and price moving averages. So you can see here we had a bearish divergence here that broke down, hit our minimum 23-38% Fibonacci range, and since then it's adjusted, and now it's starting to move in line with the price. In fact, if you go to those peaks there, you'll notice there declining highs on the CCI versus the same period on the price, increasing highs. That's a bearish divergence. So what we do now is we identify a retrace. So we take it back to that significant low, and we expect it to fall at the very minimum into that 23-38% range. Now, of course, it could go further, or it could just touch that and bounce out of there. We can't tell at this point. We just mark it as a minimum retrace level. So again, I don't trade these. I use these as a potential area to get out of long positions. So if you're holding a long position during this period here and you saw a bearish divergence, it's probably wise, once the price breaks below that moving average range, it's probably wise to get out of the position. So what I want to do now is demonstrate the back test. So I'll start off with short positions, going back here on, if you're trading on the hourly, starting back here on around the 25th of April, taking short positions. So what we've got there, the back test here from the 25th of April. This is a stop loss approach, and this is the average down approach. So you would have taken short positions, and you would stop taking short positions when that CCI broke into that moving average range on the daily. And that equated to this period back here on the 1 hour time period. And you would have got out probably earlier, because you would have noticed the 1 hour moving averages on the price were starting to go against you and going long. So you would have got out somewhere there on the stop loss approach, generating about $524 return, and the average down approach was generating about 2,900 roughly. Don't go long in that little period, because you want to wait for both the price and the CCI to break higher than the moving averages. So then once the CCI breaks below in the price, as it did then, you would have taken short positions again during this period around that area there. Started taking short positions, and again close it out when it broke into that moving average range around this area here. So what I've done here, I've let it run through the whole period, but at the very latest you would have got out probably around that period, around the 20th of May, around this area at the latest, according to the daily. And the stop loss approach generated approximately $800 worth, and the average down generated approximately $12,100 in return. Then what you do as well, what I've done here is I've started taking long positions from that point when the CCI broke above the moving average, and so did the price. And that's where we start using the back test on the price, on the long positions. So that started around that area. Now you'll notice here as well, even though the daily was giving us long trend, here we had a bearish divergence. You would have noticed that the first time after you saw that second or that peak dropping off from the original peak versus higher highs on the price. So you theoretically probably shouldn't have been taking any long trades at that point, and wait for it to then start aligning, moving in line with the price. So you can see there the CCI is dropping off, and so is the price, and your first long position would have been somewhere around that area there. That would have been an ideal area to go long, and you can see there I just let it run through the whole period. But again, at the very latest, and today you'd still be in a long positioning. We've had a couple of bearish divergence there, so you would have been wise to take some profits once you saw that second peak lower than that price peak. Kept going long there, and then again we've got another bearish divergence, as I said, with that declining CCI versus higher highs on the price. Next, looking at silver on the monthly, it's well above the moving average range on the price, and likewise the CCI is above. But what we do now is we zoom out. There's no divergence on the monthly. Then we look at any fair value gaps. You can see there, if I zoom in, I've already highlighted in red we've got a very narrow fair value gap in that range there, and another one there. So I've highlighted that whole range. So we expect at some point, again, this could take months to play out, even years on the monthly chart. So don't go placing short positions yet, but I'm just giving you an idea that it will likely drop into that area. You can see all these other fair value gaps highlighted have been filled with subsequent candles in the months and years afterwards. Even that big one there was filled with these candles here almost 2 years later. If I zoom right out, get rid of that Fibonacci. Again, this is a monthly chart. You can see all these fair value gaps have been filled with the price action. That's the monthly, so bullish momentum on the monthly. It's the first thing we look at. Secondly, on the weekly, the price and the CCI above the moving averages. But do note here, if I zoom in, first we look for any divergence. We had a bearish divergence back here. That's played out, hit our minimum target range, and it's bounced out of there. So no divergence currently in play, although you probably could argue that's a double top on a CCI versus higher highs on the price. That could be regarded as a bearish divergence, and the reason I say that is because you notice here we've got a fair value gap highlighted. So I'm gonna mark that, and very likely we're going to see the price retrace into that range in the coming weeks or even months possibly. So again, don't place short orders yet. We want to make sure we trade in the direction of the trend. So that's the weekly, and we've got another fair value gap down here which hasn't been filled. This one here has been partially filled, probably 50% of it. So I haven't marked that, but this one down here hasn't been filled yet. On the daily, again, notice here we've got these two fair value gaps. The price is currently on the resistance there and consolidating, and the CCI has already dropped in that moving average range. So we're very likely going to see it pull back and drop into this range. I would be more inclined to wait for this to break below the CCI and then start taking short trades. Other than that, we've had some really nice gains going long, and I'll show you the back test for the long positions in a moment. But again, back here we had these fair value gaps. They've all been filled with these orders. Doesn't mean the price won't retrace back into that area. It just means they've been filled, and we just highlight it there as a potential. Now, if we go to, that's the daily. If we go to the intraday chart, again, we look at the daily, and the daily we take long trades, but at the moment you would have closed out your long positions when that CCI broke into that moving average range on the daily. And you can see here, for example, when you're going long during this period, you would have noticed that first peak dropping off there versus the peak there rising. That was your first indication of a bearish divergence. And you would have taken your profits off the table had you seen that first bearish divergence. Now, in this case, I drew that range there on our last video. So what you should have done is, as long as you see that price keep rising and the CCI kept dropping, you just extend that. So what we should have done is move that to there, and we drew a Fibonacci then from that new high, and we take it back. I initially drew it to that level there, so we'll take it back to that low, and I'm going to move that target range at 23, 38% range there. So that's our new target range, and you can see there it's already hit it, it's already penetrated it, and that's effectively hit the target range. So that doesn't necessarily mean it's going to break right through, but in this case, looking at the daily, I'd suggest it probably will, and the CCI is still dropping. So again, I would not place long or short orders at the moment until you start seeing the CCI convincingly break below that moving average range. You can see there it might just be a false break if you enter too soon, like it did there. You should not have gone short there. You want to see it break below at least there if you're trading on the lower time frames. So what I've got here now, the back test beginning back there in the 21st of May. So I'll go to the long positions, and that's the stop loss approach and the average down approach. Starting back around that period there, you would have taken long trades, and that would have been close out the positions at that point there. So you can see there in this area on the stop loss approach, you were down about almost just over $100 actually, or $1,000. So you're down minus $1,000 there, and this one on the average down approach, you're up about $3,000. So that was the first point there, and then you would have not taken any trades long or short during that period when the CCI was in the moving average, and started taking long trades again from that point on. And I've let it run through the whole period, and at the moment, had you let it run through the whole period, with the price retracing, you would have closed out your positions. You can see there on the right, near the top there, you would have closed out your positions based on the daily. If you let it run through the whole period, and I'm not suggesting you do that, the stop loss approach is generating about 3,300 and the average down is about 58,100. But again, that's a bit of a risk because you're keeping the trades open while that CCI is in that moving average range on the daily. If you're new to trading, we're now including a video series, Pete's Investing Plus One, as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and help give you a better insight into our analysis and help you follow our daily videos. If you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across various regions of the world's markets. Thanks, and talk to you in our next video.